Welcome, this is part 3 of chapter 6, and we're moving into learning objective 4 now, which is really a lot of fun, and we're going to start actually changing the variable cost, fixed costs, selling prices, and volume, and seeing what those changes, how they affect our total profit for our company. We're going to use different hypotheticals, and this is where we start talking real world. So we're going to start with changes in fixed costs and sales volume. And what I want you to think about, every time a question like this is proposed, the way I like to think of it is imagine yourself in the boardroom of a company, and you are, of course, the cost accountant, and the CEO is sitting there, and the sales manager is saying, listen, if we can increase our sales from 500 units to 540 units a month, just by increasing our advertising budget by $10,000, we could really increase our profits. And that's what the sales manager is saying to the CEO, and the CEO turns to you and says, what about that? If I increase my advertising the way the sales manager is asking, and just by doing that he's able to sell 40 more bikes, is that a good thing or is that a bad thing? You will have the power to answer that, and I want you to be comfortable in doing that. We're going to use everything we just used. So what I want you to think about is what's changed here. Well, in this analysis, the volume, the amount of units that we're selling, is changing. And what's advertising expense? Does that sound like a variable expense or a fixed expense? Meaning, will the total advertising budget change depending on how many we sell? Or will the number that we sell change based upon how much we advertise? It's the latter, right? Advertising is a fixed expense, so what's happening there is the sales manager is proposing that we increase our fixed expenses in order to increase our sales revenue. So let's take a look at what the differences would be. If we increase our fixed expenses, of course, they would no longer be $80,000, they would go up to $90,000. And instead of selling 500 units at $500 a piece, we'd be selling 540 units at $500 a piece still, right? No one said anything about changing the sales price. So our total revenue would go up to $270,000. Now remember, our variable expenses are also increasing, though, if we're increasing the volume of sales, right, by that same amount. And we know that each unit we sell is another $300 of variable expenses. So by changing the volume, we not only change the sales revenue, but we also change our variable expenses and, of course, contribution margin as a result of that. But we're also changing our fixed expenses. So this is what it looks like, and if we follow the entire contribution format income statement, we'll see that the result would be a net profit of $18,000. So if we implement this change, in essence, we'll be losing $2,000. So your answer to the CEO here would be like, no, we're not going to be making that change, because even if we're able to sell those 40 additional units like the sales manager says, we're going to be losing $2,000 a month. So not a good idea to make that change. Now, I want you to be comfortable in using the contribution format income statement, and by going ahead and writing it out in your homework, you're going to be doing problems like these where you've got baseline information, right, where you're selling a certain amount and you know what the results are, and there's going to be proposals to change them, and you're going to have to compute what the profit margin would be if you went ahead and implemented those changes. Feel free and feel comfortable to go ahead and write out the full contribution format income statement if it makes you if you're more comfortable doing it. But experiment with incremental analysis as well, which is really just looking at the changes. And let me show you what I mean. A shortcut solution to what we were just doing there is we could say, hey, look, an increase in contribution margin would be as follows. We're going to sell another 40 units, and we know for every unit that we sell, we get another $200 in contribution margin, right? And by the way, this is slide 2 of the handouts. It has all the baseline information for our company. And we calculated out our contribution margin per unit is $200. Well, if you multiply that out, you'll know the additional revenue that we're going to be bringing in, right? $8,000. And not just revenue, the additional contribution margin or the additional profit. But they want us to increase our fixed expenses by $10,000. And just by subtracting out those two, the increase in profits minus the additional expenses we're going to be getting, you can see that our profits will be decreasing by $2,000. There would be a net $2,000 decrease. So we get to the exact same place we were if we wrote out the full contribution format income statement and compared it to the original data, but you can get there the same way using an incremental analysis, which is really just a shortcut, looking at the only elements that change, right? And again, going back one more time to show you, the only things that really matter that are changing is this contribution margin. In our baseline information, it's $100,000. If we implement the change, it goes up to $108,000. But our fixed expenses are also going up $10,000. And you'll see it's a $2,000 net drop. And we get the same thing from the incremental analysis. So let's try another example. And let's say this time you're sitting in the same meeting and your CEO wants to know what would be the profit impact if we started using higher quality raw materials, right? Assume those sales reps are in this meeting saying, hey, we can't compete with our competitors because they've got better quality materials in their bikes than we use. If we just increase our raw materials that we use in making our bicycles, we'd be able to sell more bikes, right? And what they're saying, what they're proposing is really just a $10 change per bicycle that we're making and selling. So $10 per bicycle. And that would generate an increase in unit sales, meaning that instead of selling 500 bikes a month, we'd be able to sell 580 bikes a month if we simply increase the raw materials that we were using, the quality of the materials to make the bike, by $10 per bike. So what's the change here? Well, they're asking for a $10 change in variable expenses, right? And that's a variable expense because it's every bike that we sell, we're going to have an additional $10 of expenses and at the same time a change in volume. So let's take a look in long form if we look at the contribution format income statements. Well, we know the volume is going to change from 500 units to 580 units, right? So we're really just multiplying that 580 by the $500 sales price of our bicycles. Nothing has changed there to learn what our total sales dollars are. But now we're multiplying, instead of the 500 times 300 of variable expenses from our baseline information, we're multiplying it by $310. That's the new variable expense per unit because they want us to increase our expenses per unit by $10. So that's how we get to the total variable expenses here. Of course, we'd still subtract out to get to our contribution margin. And by the way, if you're changing the variable expense per unit, that would of course change the contribution margin per unit on a per unit basis. And it's also going to change those ratios, right? The contribution margin ratio and the variable expense ratios, because you are now changing the amounts of those. So our contribution margin is going to increase on a total dollar level of $10,200. And since there's no increase in fixed expenses, that amount is going to inure to pure profit. So we're going to be able to increase our profits by $10,200, right? In the original information, if we sell only 500 bikes, we're profiting $20,000. Under this new paradigm, we'd be profiting $30,200, an increase of $10,200. Now let's take a look at the incremental analysis if you want to challenge yourself here. The increase in sales, well, that's 80 units, again, times the same sales price that we know is $500, right? Nothing's changed with the sales price. That would be the increase in revenue. The increase in variable expenses, well, this one's a little complicated, right? Because we're going to have 80 additional units, which need to be multiplied by the original $300 and the original 500 plus the new 80 units that we're going to be selling multiplied by the increased variable expense of $10 per bike. So the increases in expenses are kind of twofold, right? We're selling an additional 80, so we've got to add the $300, and all 580 are going to have an additional $10 of materials in them. So these are your expenses, of course, These are your additional revenues, so you'd simply subtract that out and you'd get to the exact same place of $10,200. This is a bit advanced and I want you to feel comfortable, so feel free to use that long form contribution format income statement. I do it. My homework results that I'll be posting when you guys turn in this homework will show the long form contribution format income statement. Really, a good way to do it is just to try the incremental stuff in your mind, but when you write it out, go ahead and write out the full income statements. So in our next example, we're going to complicate things a little bit more. So this time the CEO is turning to you and saying, hey, what's the profit impact going to be if we do the following three things? Number one, we cut our sales price by $20 per unit, right? Now, again, I want you to imagine the sales representative saying, man, we got to cut our costs. Our competitors are beating us. So he says, all right, if we reduce our sales price by $20 per unit and we increase our advertising budget by $15,000, and the sales rep promised me if I do that, they will sell 650 bikes a month instead of just the measly old 500 bikes we're selling every month. Turns to you and says, what do you think? Is that a good idea, bad idea? How does it work? So same thing, go ahead and write it out. One key change that's happening there is, of course, our sales price per unit is going down from $500 to $480, right? They were asking for a $20 price cut per unit in our sales price, and they're asking for an increase in the advertising budget of $15,000. So a decrease in our sales price per unit, an increase in our fixed expenses, right? Advertising is not a variable expense. Really doesn't matter how many we sell. That's not going to change our advertising budget. If we go out there and sell $15,000 or buy $15,000 of advertising, it doesn't matter if we sell one or if we sell 100,000 bicycles. Our advertising agency doesn't care. They're just putting together our ad and putting it out there, right? And of course, the volume is what's going to change. And remember, that volume is going to change not only the total sales dollars, but the total variable expenses and, of course, our contribution margin. So, writing that out, remember to write out your baseline information always. It's really just copying it, but it's a good thing to see the two. And to go ahead and write out the volume every time. And remember that the volume affects not only your sales, you're not just multiplying the new number of units by the new sales price, but also by the variable expenses per unit, which in our original information is $300 per unit. So 650 bikes times 480 gives us the total sales dollars. 650 units multiplied by $300 per unit of variable expenses gives us our total variable expenses. And of course, 650 units multiplied by our contribution margin per unit, which is going to be less now, right, than our original data because our sales price has gone down, would be 180 now. So 180 times 650, you can come up with your contribution margin or simply subtract it out. Either way, you get to the same place. Don't forget that our fixed expenses, our advertising budget has gone up $15,000, so we've got to show the increase in our fixed expenses, right? And then finally, just simple subtraction gets us to our net operating income. And in this example, of course, we'd suggest it because our profits we expect to go up $2,000. And by the way, if you're sitting there thinking, hey, what's going to happen though if we make these changes and we don't actually sell the 650 bikes that they're claiming? Well, you don't have to worry about that as the cost accountant. You just need to give sound advice and say, look, if we sell the 650, and that's a big if, then of course we will show a better profit. But if you don't, who bears the brunt of that problem? Absolutely, the sales reps and maybe the sales manager, but not you. You gave sound advice. They just didn't live up to their end of the bargain. So don't worry about that. This is probably a good place to stop. We'll see you back and continue in the last part 4 of Chapter 6.